that the market is still so skewed. I mean, oh my God. And now we're dealing with, waiting for the Supreme Court decision on tariffs.
Something Michael Burry was shorting. There was an article that came out at the beginning of the week that he's shorting AI stocks. Was a little bit of a catalyst for some of the AI names to start selling off in the beginning of the week. The prices ran up so much, forecasting all of the optimism in the stock that any little negativity, things have to just continue to go. And this is what we were talking about, that it's kind of that Goldilocks scenario and these past.
Good morning and welcome to the Wise Money Guys radio show. I'm your co-host, John Scambry, and I'm here with my partner,
Giuseppe Visconti.
And we're certified portfolio managers that specialize in helping people who are retired or about to retire manage their money. If you like our show, have questions, or want to set a no-obligation consultation, give us a call at 916-967-3500. Again, that number is 916-967-3500. You can also visit our website at wisemoneyguys.com for lots of great information. And there you will also find a chat. If you have just some quick questions, you'll find the chat bot there that will answer most and connect you to us if you want to take a deeper dive. And also, you can email us.
Question at wisemoneyguys.com.
Okay.
You're running out of alsos.
I know. I ran out of said a lot of alsos. But also, there's a lot of, these are the types of weeks that really cement why you need to be working with, an investment professional to create your financial plan, to help you with your investment off your plate so you can enjoy retirement, because, it's been all over the place. I mean, we had, a big down day, then we had, followed by a pretty good up day, now another down day, then kind of a flat day. But the point is that volatility is all over the place, and every earnings, it's very similar. And earnings, Giuseppe, haven't become about meeting your earnings anymore. It's all about the guidance. And then the market, retail investors, institutions, people managing their own money tend to overreact, based on that guidance, or based on those earnings reports.
Things have ran up quite a bit. And that's part of the reason why I'm in multiples and valuations of these stocks some of them have reached sky high. And we'll touch on some of the Michael Burry, who the movie The Big Short is about, who made all the money in 2008, who was betting on the downturn in 2008, was shorting. There was an article that came out at the beginning of the week that he's shorting AI stocks. So that was a little bit of a catalyst for some of the AI names to start selling off in the beginning of the week. When they meet or beat, that's one thing. But when they have the forward guidance and they have their earnings call, and there's anything negative within that earnings call, of course they're going to react because it's ran up so much. The prices ran up so much, forecasting all of the optimism in the stock that any little negativity, things have to just continue to go. And this is what we were talking about, that it's kind of that Goldilocks scenario. And these past few radio shows, we've been saying it's a good time to rebalance if you haven't rebalanced. Look at your portfolio. If you're in heavy in one asset class, or some of these stocks have ran up and they've become bigger weightings in your overall portfolio, might be a good time to trim, right? Spread it out to other asset classes to further diversify. And here we are. Volatility is finally picking up.
What people have to understand, though, is the earnings guidance is a game. It doesn't have to be factual. And it doesn't have to be something that you're going to disclose to the public, whether or not there's things that you expect in the next quarter that are going to either, make earnings great or make them not so great. It's more of, the pressure on the CEO, the CFO, the COO, so on and so forth.
Well, that's
the CIO.
That's the double-edged sword of being public, though, right? That's why some of these companies are moving to be private.
But where I'm going because of that. But they typically are better off under promising. So
for sure.
you can almost always expect forward guidance care about.
You forgot one.
Which one?
The main one.
The
one that's almost as important as a Federal Reserve chair.
But still, that's just one company, and it's a big one, like you said. It's been the one everybody follows, but nevertheless, so we're not going to have any big earnings news, but again, you have to be cautious around the earnings season, and don't get emotional about it and make mistakes. And over again, that's where people will tend to lose money. They bought in on something that was already, in my opinion, maybe close to value or even overvalued. And then earnings comes out. These companies do well, whether it's Apple that, reported well. I have a feeling NVIDIA is going to report big numbers, but they tend to sell off, right after, because of that forward guidance, but also because of profit taking. As you said, things are overvalued and there's starting to be profit taking.
I mean, the market as a whole. So you not only have individual companies, but you have a market as a whole is the other component that's overvalued. And then you have the dominating names that have been helping to carry a big portion of the market, right? Which we talked about. And they've been, some of them have been overvalued as well. Yeah. So aside from even earnings, it's not surprising that profit taking is happening. But there's some other things that have taken place, which has been the catalyst to picking up the volatility this last week.
Yeah, here's my and getting into this early. Here's my strategy number one, especially with valuations where they are now, the volatility around earnings, is I wouldn't rush to buy the dip. Look, valuations, financials, where you're at, meaning where a company's at, when you look at those things, especially compared to, its peers, in the same sector. Don't just extend yourself in any one particular company because around earnings, the price dips a bit. I would more sell, before earnings and trim some of your position and recommend that as a better strategy, especially if you've got huge profits in a particular position, versus, buying on the dip right now.
Yeah, and there's different strategies, and if your account is taxable or if it's a retirement account, there's different ways of looking at it. You want to make sure you're cognizant of capital gains, and those are the conversations you'd have with your advisor or us or your CPA or accountant, especially if it's a taxable account. If it's a retirement account, then you don't have to worry about that. You can buy and sell as much as you want.
Yeah, one of the things we do when we're rebalancing, especially for, as you said, taxable accounts, we're going to look at what your realized gains are for the year before we just go ahead and dump something that's at a pretty good size profit. And these are all things that I encourage you to make sure that you're getting this level of service and if you're not, putting this level of thought before blindly, or maybe not blindly, but before making a quick decision on buying the dip or trimming a position because you've made a lot of money. The tax consequence, how it affects your overall plan, all of those things are important. And again, if you're not doing things to these levels, I definitely recommend that you give us a call for a no obligation consultation, and we'll give you that baseline. We'll start that financial plan for you, all without having to commit to working with us. So give us a call at 916-967-3500. So, it never ceases to amaze me still that the slant, I don't know what the words I'm looking for, how skewed the market still is, you mentioned the NVIDIA towards AI, and still that's still the trade, today, here at what, 3/4 of the year, 7/8 of the year gone, that, it's all about what's NVIDIA done, what's all
the deals
some
between
of the other
OpenAI
semiconductors
and different
what's
companies
up,
merging. And
exactly. And what I think is happening is people are missing out on tremendous, opportunity in other areas, like industrials, like in, manufacturing, which is part of industrials, like in energy.
I was surprised you said
you were going to surprise. but there's been great opportunities also in the medical side, pharma, things like that, where you could still find positions for your portfolio that, are appropriate for your financial plan and your goals, that haven't gone up to some multiple that's way beyond, the average multiple. Exactly. So,
but more to come. We'll dive into Michael Burry. What's he all about? What's he forecasting? What is he shorting, mostly of those big AI names? Reaction to tariffs. We have Supreme Court and Trump's tariffs coming up. The 10-year Treasury bond and what's going on with that yield. How is that impacting the markets? And then we've had, because of the government shutdown, we haven't had some of the economic indicators and economic reports put out there. But there's been ADP reports, the Challenger report, that's giving us some insight on the employment, the status of the employment out there when we come back.
We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my partner, Giuseppe Visconti. And you gave a lot of good bullet points of what we'll be talking about. But one of them is one that, God, if I hear just any more about it, which we're going to, but just, I was talking about overreacting on the earnings side, that the market is still so skewed towards, gosh, what's happening with the AI companies, so on and so forth. The other kind of news and headlines that have driven, market reactions and really driven market overreactions is tariffs. I mean, oh my God.
Right.
And now we're dealing with, waiting for the Supreme Court decision on tariffs, whether or not they're a tax, or more importantly, whether or not the executive, the president, under his emergency powers, has the ability to tariff countries. I believe he does. I believe the two acts that I've read give him that authority. So we'll see. Also, I think that's a really big deal if now you have the Supreme Court legislating on congressional, fiscal policy issues. I mean, that would just be way, way out over their skis. But we'll see how they interpret the two acts that the president has been using that were passed by Congress to give the president not taxing, but tariffing, if that's a word, tariffing, yeah, I guess it is, authority. And so that's huge. But still, some of those things also impact, as you've said, the interest rates.
Well,
10 years, so on and so forth.
And if it does go through, and if there's got to be a refund of those tariff and custom duties, right?
And how would you give that money back?
I don't know.
And why would you?
Yeah, I don't know.
I mean, that's too bad. So
that's sad. What people are like, how would that look like, and how would that carry out?
Again, the Supreme Court has no such authority. They have no fiscal authority whatsoever. If they say, oh, yeah, you tariffed another country, by the way, and we think it wasn't, exactly as the act allowed, they're going to say you have to. First of all, they can't do punitive things. That would be like a damages decision almost coming from a court to say, okay, you violated this, that, or the other. Now your punitive damages, United States of America, are to pay back China and give me a royal break, or whatever country the proceeds came from.
Yeah.
And I think just that alone is one of the reasons why they may figure out a way to guide on the case, but not really come out with some sort of concrete decision on it,
right?
Because you just can't. The president has the authority to tariff other countries, especially through different emergency acts that give him more authority than just the typical path to any sort of fiscal decision, which typically obviously has to go through the process through Congress and the Senate, and then get signed into law. And that's not how these things are being done. And I think,
I mean, the data, and I think the concerning part, or the thing that I'm looking at when I'm reading through this data, is how does this unfold in the long run, right? Not so much in the short run, and not so much if we have to refund the tariffs or not, because I'm thinking it'll probably stick, and there'll be tariffs continuing on. And so what does that look like? What does that look like long term, right? Not this 6 to 12 month window. It's how do companies and corporations adjust to that? Because we've taken in, right, a little over 200 billion, but from corporate tax receipts, they fell by 50 billion. So what that says is that they're taking the initial hit, right? They're not fully passing on these tariffs and these adjusted costs to the consumer, but that can't last long term, right? At some point, either the deal between those entities, countries, whatever, has to get down to a better equilibrium number, whatever that is, right? Hey, we have you at 25% tariffs. Why don't we move it down to 10, or so on and so forth, right? Or not,
manufacture things in the United States and buy goods and services from companies that do.
If it was that easy,
but
at some point,
that easy.
But there's going to be a cost to revamping the manufacturing in the U.S., right? So it has to make sense. You can't just manufacture whatever. But the things that we're good at and the things that make sense,
we're good at everything.
But to have a factory to make socks and charge people double the cost for socks,
you can't do it.
Doesn't make sense. So it makes sense to outsource, but it makes sense to outsource
only because
to countries that are allies, right? To friendly and not adversarial countries. That's the big thing, that we're willing to work, that, hey, we can outsource X, Y, and Z to you, right? And then you outsource, or you trade back with us, right? Because we have resources or skill set or something that you don't, and there's a good trade right there. No, and we're gonna keep it.
Here's the real gist of it. Let's be completely frank about it. The reason why companies have outsourced to foreign countries is because of the cost of labor. End of story.
Well, yeah, of course.
Not because they're better at something or have more resources.
You said it right there. The cost of labor. So if they have to bring it home.
Wait. Here where I'm going on this. So we just got through with 400 major companies reporting earnings so far. 82% of them exceeded already lofty expectations of their earnings, beyond their previous quarter's earnings, beyond their fiscal year earnings. And yet, so what we're saying is, in order to keep, and wow, this is really sounding a little bit left for me, in order to keep corporate profits at record highs, we will continue to use, if for lack of a better term, child labor, countries that don't have labor laws, that can pay kids pennies to manufacture socks.
You're going extreme, though.
But
that's extreme.
But that's my point.
That's extreme.
We can absorb.
And so they are
in labor.
So we see that. That's what the data says. They have absorbed it. They have to absorb it. My concern is, how much do they absorb, and for how long, until it passes on to the consumer, right? Yeah. So there's going to things, and it doesn't have to be extreme where you go into some third world country child labor,
which is what
there are other
what
countries,
companies have done,
right,
for decades,
right. But why not have it where you can just go to another country where labor and land is cheaper? The United States is expensive, right? We have cheaper parts in the United States, which would make sense, but in general, it's expensive, right?
Yes,
and so you'd have to. So there's plenty of other places out there, and it doesn't have to be China, an adversarial country. There could be other places out there. It's just they've got stuck in their ways. And to your point, yes, they've got stuck in their ways. They've made a deal with China years and decades ago, and they've been bringing in these massive profits. Right? You buy a pair of Nikes that cost $3 overall, and they sell them for $100 or whatever, right? And they get used to that. But now we're
clearly haven't bought a pair of good Nikes in a while.
No, I'm not paying $150 for
actually
synthetic
some of them
material.
go up, above $200 for a pair of tennis shoes.
Yeah, you won't see me with those.
Yeah.
It's synthetic. I look at it as synthetic material that costs nothing. I know it costs nothing. I'm not paying $200 for it. Yeah.
The material itself,
I want it to be
bulk is pennies.
I want it to be real leather.
Yeah.
Super comfortable. Yeah. It can last for like 5 years at least.
And the leather to go with your gold.
My gold?
You're Italian. Right?
I was going to say
it. Love gold. Your gold.
But we'll see where this data goes. That's something to look at, right? And to pay attention in regards to the whole tariff situation. So far, the market has absorbed it and has been resilient because we've been hitting all-time highs. I mean, not lately.
But again, back up. We're hitting all-time highs because of record profits of these companies.
Right.
That's what I'm saying. So your point,
but they could still profit. They can still profit.
They would still massively profit, even if the cost of production, as long as productivity is going up, as long as supply is outpacing demand, even if costs cost more for these companies to create their output of a good or service, as long as supply and productivity is there will be no inflation. That is the key. That's the difference between. That's what supply side economics are. Is it's about increasing and making productivity more efficient, so that you have increased supply at a better cost.
Yeah. So maybe some of those things through AI and robotics can help replace some of that.
Sure.
But that also comes with a cost too, right? AI costs something, robotics costs something, and it'll get to a point where, okay, over 5 years, maybe we hit a break even, and then we become a profit. So all those things have to be worked out. But it's interesting when I just saw that data, because so far, corporations, major corporations have been taking a hit. We'll see how long that lasts.
Yeah. At the end of the day, we have these conversations and put them out there, in an open forum into the public, because this is the types of thoughts and really the effort you have to dive into to figure out, where to put your money, where we put people's money, and what type of portfolios we build for them is based on the data that is constantly, coming out and changing. And it's a lot more complex than just, kind of circling back, just, I like this stock. The stock just dipped for whatever reason. I'm going to buy more of it. Or I like this stock. It's gone up to real lofty levels, and I'm not going to sell any of it. Those could all be the wrong decisions. And when it comes to your retirement wealth, your retirement income, your legacy assets, the things that you have worked to build your whole entire life and save, don't go it alone. Give us a call at 916-967-3500 for a no obligation consultation and a complimentary retirement plan analysis. And more importantly, stay tuned. You're listening to the Wise Money Guys, John Scambray and Giuseppe Viscani. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my partner,
Giuseppe Viscanti.
And, we're talking about a lot of things that really impact investment decisions that we make for our clients, and that you should consider when you're making investment decisions, if you're going it alone, or hopefully you're getting, the level of attention that you deserve from whoever you work with, and whoever your professionals are. If not, again, give us a call. But there's just more going on. So if it's not the tariffs, if it's not earnings,
there's more.
Yes, and there's more. But
if you buy now,
we'll give you a set of Ginsu.
We'll add on a second set.
But reality is, what we've been dealing with all year is a major focus on the tech sector. Within that tech sector,
both on the downside and the upside.
On the upside, AI earnings. And if it's not that, then it's been tariffs and what's going on, with tariffs and negotiations with China, the EU, Canada, Mexico, other Southeast Asian countries, so on and so forth.
And you layer on the shutdown.
And then you layer on the government shutdown. You layer on inflation data and interest rate decisions from the FOMC, so on and so forth.
Stressing me out.
I know. Is a bead of sweat starting to come down my forehead? But even with that, it's still been a year to where if you weren't emotional, if you worked with people who, focus on portfolio management and focus on, creating the portfolios that are in line with your plan, your goals and objectives, then you haven't had to really, worry about all of those things. But still, some of the things that we worry about, from, a 10-year treasury or an interest rate decision, is whether or not we can get you into, good bond rates and right. things like that, or some of the structured notes that we like. And, if some of those might be being called, and there's just so many things. And still, I'm looking at this list, and why don't you go through some of them? Because it's not going to slow down here at the end of the year, even though at least we don't have, another big Fed kind of decision. But once again, you want to be really diving into your portfolio from a tax mitigation, from a rebalancing, and getting yourself set up for having a good year next year. And all of these things should be considered.
Well, and it has to align with your overall plan. A lot of people, and we've talked about this several times, is people get carried away with some of the details or diving into the weeds. We kind of dove into quite a bit of weeds so far in the show, but you have to zoom out, right? For your own personal picture, and focus on things that are important to you and your family, and say, okay, what's the macro picture? What am I trying to achieve here? Whether it's retirement or whatever financial goal that you have out there, there's going to be a timeline on that, right? If it's retirement, what does my retirement look like for the next 20, 25, 30 years? And what does my money need to do for me for that period of time? A lot of times people will get carried away and be like, I'm going to jump into, this stock or that stock because it's taking off, or it has something to do with this technology or that new technology or drones or so on and so forth. And, I can make 100, I can potentially make 100%. I missed out on that other one that went up 100%. How can I? Great. If you can add some of those into your portfolio, great. But if you're just focusing on all those little aspects all the time, you're going to be moving around, and there's really going to be no method to the madness, other than just trying to chase performance. And then when you have volatility kick in the markets, when you have some of these things that we talked about of, tariffs and AI and disruptors in AI, or, profits aren't going to be as fruitful as we thought in AI, and all the spending, like Meta was one, right, where they came out and said, we had all the spending, and they went down 11% the very next day. Those sort of things, then that forces you to start making emotional decisions, because like, oh my gosh, maybe I was wrong. Maybe I don't. Well, you didn't need to go after that stock to go after a 50 or 100% return in the first place, right? And so you didn't need to take that investment asset that has such a high volatility, right, ride, and put that into your portfolio. It's focusing on the big picture, putting a plan around how do you successfully create longevity with your assets. You could take a small portion of it and go after the gusto, but you don't want to take so much and put too much emphasis where then it could blow you up, right? Where April and May this year, people were panicking if they had a heavy weighting in certain stocks. Overall, the stock market goes up, but it's a tactful ride, and you want to be choosy in your investments. Some of the things that are hitting the market right now, like we've already talked about, is Michael Burry. If you hadn't seen the Big Short movie, it's all about 2008, and this guy made billions of dollars shorting, which basically just means putting investment bets out there. When things go down in price, you make you make money even though it's going down. He's making a bet, and I said AI stocks, and that article came out. But when you look at his positions, it's more on Palantir. Palantir is a big one that because it has a PE of 213. That's very, very, very high. NVIDIA, for example, has a PE or price to earnings of 33, just to give you some concept. So, has he made his money in Palantir, shorting Palantir yet? Is it still out there? I don't know. I mean, he's so far probably done pretty good this week.
Yeah, this week, but who knows? He may have been at a loss if he started shorting it, months ago. Because Palantir's 52-week low, or low just this year is in the 50s. And
yeah, but recently it's been
it's
high.
closer to 200.
Right.
And so just depends on when he started shorting the stock. And just so you understand that, shorting a stock basically means you borrow shares. You don't own the shares. You've borrowed shares, and your debt is those shares. It's not the dollars that those shares represent. Your actual debt is those shares, and you want to repay back those shares at a lower price than what those shares were valued at when you bought them. That is what shorting means. And so there's different ways to short and hedge that have a different type of purpose, but in essence, you're borrowing shares. So let me give you a quick example. Any stock, doesn't matter, and the current price is at $10, and I think the shares are going to go down to $5. So I borrow 1,000 shares. That's in essence borrowing something worth $10,000. Okay, I receive $10,000. All right, now I return those shares when it cost me $5,000 because the stock price went down to $5. So I return those shares at a cost of $5 a share, or $5,000. My net profit is $5,000. So that is how you make money shorting, is you expect the share price to go down. You borrow shares, hopefully at a higher price than you return those shares at. That is lesson 101 today, shorting a stock.
Yeah, and if you haven't done it, don't just go rush out and try.
Oh my God, please, because
very risky.
Limits are unlimited. So let's say now you short a stock. Let's use that $10. What did I say?
$10 stock.
No, well, I thought I said risk is I said limited. It's
limited. It's
unlimited.
Unlimited. Yeah.
And so let's say again you decide to short a $10 stock and you do 1,000 shares. What if that stock goes to 100? Now you owe those shares back at 100,000, and you only received 10,000. You just lost $90,000. And by the way, that's what drove, the crash and made it worse in any major market crash. Short people and people who are short the market,
5 feet, under 5 feet.
People are short the market. Got margin calls, calls to cover their losses, and they didn't have it. So then they declare bankruptcies. And so, we had a client, I'm sorry to take us out on a tangent, but we had a client who was interested in some leveraged shares. Leveraged funds tend to have short bets on the market, and short bets are great a lot of times, or they've borrowed shares against their position, which i.e. leverage, but also they've borrowed shares, and they've borrowed them at, again, let's say it's $10 a share. Now those shares have gone up, drastically, and they have to repay those shares at a much higher price. So using leveraged funds, using things that have short positions can be very dangerous, especially in a bull market. Now, if you're just purely on the bull side, where heck, I'm doubled down, okay, let's take I own these shares instead of I borrowed these shares, and then I borrow money to buy even more shares, i.e. the leverage, and the share price goes up, ching ching, winner winner chicken dinner. But again,
whole another strategy. Yeah,
you're leveraging, borrowing, shorting, it amplifies your risk.
Right.
And so from a retirement perspective, I highly recommend, if you're retired and you have your million, your 2 million, your 500,000 in investments, don't get caught up in potentially, success stories. And typically they're stories on, how great levered investments can be, or shorting can be. It's far riskier to be a bear and making big bear bets than it is to be a bull and just riding out, market volatility.
Right.
All right. You're listening to the Wise Money Guys, John Scambray and Giuseppe Visconti. Stay tuned. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and I'm here with my partner, Giuseppe Visconti. And before I make a shameless pitch for people to call us and come in and get on our calendar, any more, current events or things that we should touch upon?
Yeah. Some of the other concerns out there is some of the data that's coming out from ADP and then the Challenger report, just showing that there's more layoffs happening. Maybe some of it's tied to AI. And just the efficiency that's creating. But that is, a concern, because obviously the Federal Reserve is focusing more on the status of employment, or therefore unemployment. And that's why
versus
they've
CPI
had
or PPI or
PCE
or
versus inflation, which drove them to have these 2 rate cuts so far this year. We'll see if they do another one in December. And then,
this actually might be the best the Fed can be, because think about it. They use false data, revised data, and data that almost is never, correct. Because think about it: CPI, PPI, PCE, all these, unemployment numbers. The Bureau of Labor Statistics I guess, being the main driver of some of this data.
I have one question though.
Yeah.
Did you have coffee this morning?
I did have a cup of coffee. So,
yeah.
But
I can't say that I'm surprised. I could tell.
But the reality is they give all these monthly numbers, quarterly numbers, and then they revise them a month later or quarter.
You said it many times before.
This might be,
but that's the data that they have.
Decision making that the Fed does, because they don't rely on data that's just going to be revised and wrong anyway. What do you think?
I still don't have complete faith, because they're kind of late in the game. But yeah, we'll see how.
Mike Powell is why he's been given that nickname.
Well, here's the thing. I mean, you don't have to be a rocket scientist, but like you have like 100 something PhDs, all economists, so on and so forth. And then they admitted back when inflation was going sky high and it was CPI was over 9%, right, in 2022, and they admitted they're wrong. Janet Yellen, Jerome Powell admitted that they were wrong, and it was transitory. So really,
it wasn't transitory. Is the point.
That it was transitory and they were wrong. What I'm saying is they admitted that, oh no, it's not transitory. We were wrong, and therefore we have to start raising interest rates.
It was transitory, and it wasn't.
And the problem is,
they admitted it.
Yeah, and the problem is it because they didn't have enough data, or is it because the data wasn't correct?
It was manipulated,
or manipulated, or is it political, right? Or is it a combination of all? But unfortunately, this is data we have. Maybe at some point they revamp it to get more accurate information. But so far, the data that we have coming right now, we don't have data. We still don't have certain data because the government's still shut down. But the data that we do have is suggesting that there's more layoffs. So that emboldens the Federal Reserve and where they're at and the decisions that they've made as far as the 2 rate cuts that they've had. We'll see how it continues to unfold for December's meeting, and if they do another quarter point rate cut. The low-income households, what the data is showing is rising credit, auto, student loan delinquencies. On the other side of the spectrum, the wealthy, the baby boomers, and so on and so forth are still spending. So that's still creating resiliency around their consumer spending. And so you have this dichotomy here, right? Or binary or division. Lower income is feeling the pinch, especially with the inflation that's had taken place in the past few years. Things cost more money, right? And so you're seeing credit card debt rising, delinquency starting to happen across different areas of loans. But on the other side of the spectrum, you have stock market that had a couple great years, right? People making, you have some areas of the industry where people are making more money than they've made before. And you have the wealthy who have been invested in either real assets or liquid assets like stocks and bonds and things like that, and have seen their portfolios appreciate, and they're continuing to spend.
Yeah. So let's recap a little bit. So main strategies that we've been discussing today are really take a deep dive before making a decision or overreacting to earnings or any of the news on tariffs or the shutdown or on interest rate decisions, so on and so forth. Don't just, buy more of a stock because the price dipped here. It still might be overvalued even after dipping. And then also, if you do have a highly appreciated stock, consider trimming some of that position. You don't have to get out of all of it, especially if you have a tax consequence, but consider, rebalancing right here before the end of the year and focus on, what sort of tax impact it has. Now, if these aren't things that you normally do for yourself and you're not sure they're being done, let us help you. We will do a free portfolio review. We'll try to help you understand what sort of gains or tax consequences you are. We'll help you understand, the level of risk that you have in your portfolio, and maybe you don't need that sort of risk to get the type of cash
if it's
flow.
aligned to your plan.
Yeah, to get the type of cash flow or income out of your investments. Maybe you can take less risk because you don't have good quality, high-paying dividend positions like certain stocks or ETFs or alternatives. Maybe you're not, you've been just riding money market interest rates down on your cash, and there's still great bond rates out there. There's great note rates out there. All of these things we will be happy to share with you with absolutely no obligation by giving us a call at 916-967-3500. Get on our calendar. We can meet via Zoom. We'd love to meet you in our office if you're in the Bay Area. We have a convenient location there for you in Walnut Creek and in Concord. Also, if you're in the Tahoe, Reno areas, we can meet there. We love meeting people face-to-face versus over the internet, which I believe is a dying thing, and I'm so happy that we still do that. The webinar, the Zoom.
So you meant the internet. I'm like, what?
No.
Yeah,
just that. We're all about face-to-face, and we will come to a convenient office near you.
We still do Zoom and what have you.
Some
it's
people
convenient.
are comfortable with that and want that.
But we don't mind at all meeting face-to-face. We prefer
but
it.
We're old school. We prefer meeting face-to-face. Again, to get on our calendar for an hour or two for that no obligation consultation, call 916-967-3500. Well, I hope you enjoyed listening to the Wise Money Guys, John Scammery and Giuseppe Fiscani. Have a wonderful weekend and come back and give us a listen again next weekend. Bye all.
Great weekend.